Hi, I'm Steve LaFrance, and welcome to our August market update. After a strong first half, markets paused in July as investors digested renewed geopolitical headlines and a subtle shift in monetary policy tone. The S&P finished roughly flat for the month, holding its year-to-date gain of 10%. Beneath the surface, sector rotation was the story. Energy surged 12%, financial 6%, and defensive areas like real estate, healthcare, and staples all posted modest gains, while technology pulled back about 3%, as AI-related names cooled after an exceptional run. The backdrop remains complex. The US-Iran ceasefire broke down early in the month, reigniting concerns around the Strait of Hormuz and pushing oil back above 80 per barrel, before easing late month. Each flare-up has followed the same pattern this year. Conflict, followed by high energy prices, then inflation worries, and then partial relief. The Fed held rates steady for a fifth consecutive meeting at 3.5% to 3.75%, but several officials favored a 25 basis point hike, underscoring the tension between inflation vigilance and patience. Economic data continue to show resilience. Second quarter GDP grew 1.5% annualized, slower than Q1's 2.1% pace, but underlying components were solid. Consumer spending and business investment remained strong, particularly in AI-related CapEx. Inventories fell sharply, temporarily dragging growth lower, yet lean stockpiles suggest potential rebound ahead. Payrolls rose 57,000 in June. Unemployment held steady near 4.2%, and wage growth remains steady, all signs of a still healthy labor market. The AI narrative itself has evolved. Earnings from the major platforms, Microsoft, Alphabet, Meta, Apple, and Amazon, shifted focus from scale to discipline. Investors are now asking whether massive data center spending is translating into profits. Companies showing clear returns on investment were rewarded. Others saw their shares retrace. Semiconductor and infrastructure suppliers gave back part of their earlier gains, yet remain up roughly 50% year to date. This rotation from growth at any cost toward profitable growth marks a healthy maturation of the AI cycle. Internationally, developed markets outperformed 2%, while emerging markets lagged at -3%, amid the same tech sector volatility. And yet they're up 12% and 20% respectively year to date. Bond markets softened as yields rose, and the 10-year Treasury climbed to 4.75%, its highest level since 2007, reflecting both inflation uncertainty and the Fed's hawkish tone while continuing to show confidence in corporate fundamentals. So in summary, July brought consolidation rather than correction. Energy strength, solid earnings, and steady economic data offset the AI pullback and geopolitical noise. As we move into late summer, the key watch points are inflation trends, Fed policy at the September meeting, and whether corporate spending continues converting into sustainable profits. Our team will continue monitoring the data and helping you navigate what's shaping up to be a dynamic second half of 2026. Thanks again for your trust and confidence.